You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. Well, last week we talked a little bit about just trading in a very in-the-news underlying, and the stock that we were looking at was Tilray. It is a stock that is based off of marijuana and marijuana sales, and it's basically their main business for both for healthcare and for just recreational purposes. They're a Canadian company, and the market's been crazy in it. And our recommendation that week, or our paper trade, if you would, was to just lay down until the urge went away. The markets were crazy, and I tried to explain why the options were trading for the prices that they were trading for. Okay, so we're going to jump right back into our strategy for this week, and we're starting to drift into the earnings season again. And I always like to look at earnings on a little bit higher price stocks, and I see that Costco is going to be announcing earnings on the 4th after the close. Now, important to note on Options Playbook Radio, everything we talk about is just for learning, not meant to be a recommendation, and we are taping this show as of Wednesday, September 26th. The markets are closed right now, and we are looking at Costco. At the end of the day today, it's trading at 233.81. It was up 88 cents on the day, and they're announcing earnings on October 4th, which is a Thursday, and they're going to look to announce those earnings after the close. So when I look at Costco and I look at the volatility, just a 1-year implied volatility chart, you're looking at 30-day historical versus 30-day implied. It's a weighted average. That's what we have in our volatility charts here at Ally Invest. And we see that the implied volatility is starting to creep up, but it's not insane as far as the 30-day is concerned. It's right around 21%. Historical is down a little bit, but relative to the yearly volatility in Costco, the yearly low was around 15%. The yearly high was almost 40%. So we're still in the mid-range, and they're going to be announcing earnings fairly soon. So just because of that, and flip a coin, look at the chart. The chart looks like there really hasn't been much going on. It's had a great run up for the year. It's backed off a little bit, and then over the last couple of weeks, it's just kind of traded nowhere. So let's say that it's going to go somewhere. We're going to do a trade just guessing that it might go somewhere. Flip a coin if you want to be bullish or bearish. I did that. I picked bear. So we're going to do a volatility spread. And another name for the volatility trade is actually called a backspread. So inside the options playbook, if you have one on the table, look for a backspread with puts, aka a ratio volatility spread, and also sometimes referred to as a pay later put. And I will actually tell you why they consider it a pay later put once we get into the strategy. So looking at the option chain, once again, the market is at 233.81. We're going to try to sell an in-the-money put to help pay for an at-the-money put or a fairly at-the-money put. And we want to sell one option to pay for two, and hence the name ratio in the term ratio volatility spread. So we're going to go a little bit farther out, and we want to get this done for a net credit. If we can't get it done for a net credit, then I don't really want to do this trade. So we start by looking at, well, what is the market expectation of the move of Costco after they announce earnings? So we just look at the long straddle for the nearest expiration that contains the earnings. And that expiration date is October 5th. And we'll look at buying the, we'll look at the 235 strike with the market at 233.81. Call and look at buying the same put with the same strike. It's trading, I'm going to round off here because this is not an exact thing, trading for about $9. So we are expecting the market to move more than what the expected move is. That's why we are doing this trade. We think implied volatility is lower than it needs to be, considering there are earnings. So we're going to try to do a trade that will take advantage of it. We're going to make a little bit. If we're wrong and the market at least makes the move to the upside, and we have the potential to have a good bang for your buck if we are right on our forecast and the market goes down. If the market just stays where it's at and it does not make that expected move and it just sits exactly where it's at, that's where our most risk is at. So we're going to be centered right around the strike price that we are selling. And if the market stays there and they announce earnings and the stock doesn't move at all, that's where our greatest risk is on this trade. And that's what a put back spread is, or a volatility ratio spread. Okay, so here's the trade. We're going to go out a little bit farther in time because time can save us on this underlying. It's a fairly high-priced underlying, $233, and time premium is, in essence, right? You're going to have, even though vols aren't extremely high on this underlying relative to other stocks, you still get a lot of juice just because it's a $233 stock. So we want more move. We like more time for it to make the move, and the time premium can protect us if we're wrong on our forecast. So I'm going to go and look at the 16-day option contract, the October 12th expiration. We're going to go about 10 points in the money because that's what the expected move is. So we're going to sell the 240 strike put, which is an in-the-money put. And we are then going to use those proceeds to try to buy two of the 232.50 strike puts, which are just out of the money. So the width between the spread is 7.5 points. We have an expected move of about 9 points. So it's very possible that it could make this type of a move either to the downside or to the upside. We're going to do this ratio spread for a net credit of 15 cents to the account. At least that's where the midpoint is at right now. And if we do it for 15 cents, if we do it for 15 cents and we are dead wrong on our forecast and the market goes up above 240, well, we can make that 15 cents less the commissions. On the downside, we have one more long put than we are short, so we have substantial upside if the market goes down, but we need it to move at least the width of the strike, which 240 minus 232.50 is 7.5 points. And if you think it can move more than that, well, then this is a type of trade that you would like to do. If we are dead wrong and right at expiration, the stock expires at the strike that we are long, the 232.50 strike put, then we could lose the maximum, which would be the width between the strikes, or 7.5 points, minus the net credit brought in, right? So $735 for every 1x2 spread that we do, or 7.35 points. And plus commission. And you got to think about commissions, especially when you're doing a multiple leg trade with a ratio in it, a 1x2 ratio. Okay, so we're going to go out 16 days. We're going to go out 1 week past what the expiration that contains the earnings, October 5th expiration. And so let's talk a little bit about that. We've done a lot of skip strike butterflies, and then on the skip strike butterfly, you need the time premium to erode if you're correct. So if we were looking at doing something where we thought the market would stay within a range and we'd have a potential to make money on the skip strike butterfly part of it, we would do the October 5th expiration. Because if you're correct on your forecast on a skip strike butterfly, you want the market to go to the short strike and just sit there, and you need time premium to erode. The opposite is true when we're looking at a volatility spread where we want it to move more. So the fact that we could go out farther in time and still be out the duration of the expected move, right? So right now we need it to move 7.5 points. The expected move is 9 points. So it's a very fairly priced trade relative, is a good thing. It's a very good thing that we have 16 days for this trade to live, and we don't necessarily have to get out of it the very next day after they announced earnings, and the time premium can protect us if the underlying stock just doesn't move as much as we were hoping it to move in this scenario. Now, the question then comes up, well, if time is our friend, well, why don't we just go out to the end of October, pick the October 26th strike and do it? Well, the answer is the farther and farther you go out in time, the harder and harder this is going to be to get done for a net credit to the account. And I only want to do this trade if I can receive a net credit for doing it. That just means that if I can get the expected move either to the downside or to the upside, I can manage to be profitable on this trade just from getting the move that the marketplace is expecting. Now, can you do this in all underlyings, and can you do it in a stock like Walmart? No, a lot of times no. Just because of the price of the underlying, it's hard to get a trade done like this and receive a net credit to the account for doing it. So that's why on Options Playbook Radio, when we're looking at these strategies, we're just looking at specific situation. We're keeping an open mind when we go out and look at the stock and say, okay, let's take what the stock gives us, as opposed to going out and saying, I have this forecast on this stock, and now let's go find a strategy. When we're looking at these earnings trades, we're saying, okay, this implied volatility isn't high relative to the yearly implied volatility on Costco, and yet they're still going to announce earnings. So we're going to do this strategy because we literally think implied volatility is lower than it should be relative to a big earnings announcement. All right, so let's go back through it. There's a lot there to unpack. Let's start from the very beginning of setting up the trade. Costco today closed at 233.81. We are taping the show on 9/26, a Wednesday. The markets are closed right now. The Costco was up 88 cents on the day. We're going out and past their earnings date, which the October 4th after the close is their earnings date. And we're going to use the October 12th expiration. We're going to sell one in the money put, the 240 strike, to use the proceeds to try to buy two of the at the money puts, the 232.50 strike. We're hoping to get this done for a net credit to the account of 15 cents. We have substantial upside if the market goes down, and we have limited and known upside if the market goes up. Our maximum risk on this trade is $7.50 minus the net credit received, or $7.35 for every 1/2 ratio spread that we put on. Total cost would be $735 plus commission to put on the trade. That's it for this episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show or a question you'd like us to answer on the program, please email me at theoptionsguy@invest.ally.com. That's theoptionsguy@invest.ally.com. We're going to be having a huddle up very soon here with myself and Mark Longo, so please get your questions in now. And we'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook was brought to you by Trade King Group. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to TradeKing.com/ODD to review additional risks involved with trading options. Securities offered through TradeKing LLC, member FINRA and SIPC.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.